Welcome to our third quarter video update. I'm Janet Kim Singh, Portfolio Manager at Capstone Asset Management, and it is my great honor and pleasure to once again welcome Glenn Murray, Chief Investment Officer and President at Capstone. And of course, joining me as well as my colleague and fellow Portfolio Manager, Maria Dawes. So without further ado, let's jump right into the questions we have lined up for Glenn. Maria, if you don't mind starting us off.
Absolutely. So Glenn, we spoke in our last quarterly commentary about the stimulus measures rolled out by our government. Maybe you could get your general comments on whether these benefits are doing what they should be doing in your eyes and how these stimulus measures have affected the economy.
Sure. Thanks, Maria. Yeah, I tend to view the stimulus through its impact on both individuals or families and businesses. As I've mentioned in previous updates, I believe the response of the stimulus packages for businesses was slow in execution, and in some forms, such as rent relief, was poorly conceived. The results of this has contributed to portions of the business community continuing to struggle, being operationally at risk, having limited ability to invest in growth, and when the businesses finally did open, had some difficulty finding employees. For individuals and families, though, looked very different. The government poured money quickly into the hands of those in need and many others. There was a broad approach to provide as many groups of people that they could think of with access to significant dollars that the government was raising. Now, obviously, the country needed stimulus during this period with all the mandated shutdowns. But as we look back now, we can see some of the impacts of these decisions. For example, Canada's year-over-year deficit growth was the largest in the G20 and the fourth highest in the world. Bank of Canada's balance sheet has increased to approximately 27% of GDP, which is significantly higher than the average for the industrialized world. Shockingly, though, while labor and other forms of income are down in 2020, personal disposable income is up significantly. So let's think about that for a moment. While we find ourselves in the middle of a recession and a pandemic, on average, people's disposable income has gone up, and that is well above pre-pandemic levels. This is tied directly to government transfers. This excess in the hands of consumers has likely contributed to the initial recovery we saw as the economy reopened. The support to business, though, has hampered many companies as they attempt to remain open and keep people employed during this period.
Thanks, Glenn. There definitely seems to be some inequality there. So perhaps on a related note to that, we are now apparently in a second wave. So hypothetically, if we were having to go into another major shutdown, what are the implications?
Yeah, I probably don't like to give things titles. It doesn't really matter what we call them. The problems tend to remain the same. We are already seeing significant shutdowns in various parts of the country. The last time we talked, I'd indicated I believed they would avoid kind of the complete shutdowns similar to the spring if possible, and would take a more targeted approach. At this time, I think that appears to be the strategy that is being used by the various governments, and I think that will continue to remain the primary strategy. Much has been learned about necessary protocols and behavior. This learning hopefully will lead the country to navigate through this season and avoid another spring-like shutdown. I think it's extremely difficult, though, to predict specifics about the impact of further wholesale shutdowns. But we do know the impact will be determined by the various governments' responses and the corresponding effectiveness of those responses. There has been an update to the rental relief strategy that appears to be more favorable to businesses, so that's going to help for sure. I believe finding ways to support businesses will be the key if there are major shutdowns, or even with these current targeted shutdowns, to ensure we navigate through with businesses that are still able to remain solvent and keep people employed. So the first round showed an ability to get money into the hands of families. We would need to see a similar focus for businesses to avoid long-term implications.
Yeah, I wholeheartedly agree, Glenn. So we're talking a lot about the government's response, and one concern that clients bring to us is the fact that these governments are running up such large deficits. What is the impact and implication for the future generations? Does this mean higher taxes, or can you give us some scenarios around
Yeah, I believe that really is an important question for Canadians. No real simple answer for sure. And I don't think there is much debate, though, over the need to have provided the emergency funding due to the pandemic. However, how we proceed in the future will have ongoing impact. This is obviously one of those topics which divides public opinion. So, kind of let's focus or highlight what we do know. Canada's deficit is running at approximately 20% of GDP, which is similar to World War II levels. This is not a sustainable level over the long term. Gross domestic product, GDP, has contracted significantly over the first 2 quarters of 2020. So you have GDP coming down while debt is going up. Interest rates are currently extremely low, which obviously makes debt cheap. This can create a sense of freedom in government to run increasingly larger deficits. However, debt for governments doesn't need to necessarily be paid off completely like in personal finances, but it does need to be able to be carried. What we do really need is to have GDP growing at a rate above the growth of debt to ensure that your debt to GDP ratio is being reduced over time. So the risks in the future exist that we see interest rates start to increase, or GDP does not grow as fast and get ahead of the debt growth. So how we pay for the debt of the current size and what we're doing will be determined by the success of government reducing the size of their ongoing deficits below the growth rate of GDP, finding ways to appropriately stimulate the growth of GDP, and maintaining low interest rate environment. How that is accomplished will likely divide public opinion, but I believe it's pretty safe to say taxes will be involved.
Thank you, Glenn, for your insights. I know we're not done yet, but I do want to talk a bit more specifically about our funds. And our traditional equity pooled fund has performed very strongly this quarter. Could you give us some insight into the bigger contributors that helped to achieve this return?
Definitely, but I'd also suggest it's done well this year. As a quick update, at the end of last week, our I-Series year-to-date return was 9.65, a 6-month return of 27.88, so just below 28%. And that's continued to be delivered with less volatility than the indexes. During the early stages of the pandemic, we did make some adjustments in our portfolio. We removed a little of the excess risk that we saw, and we reallocated some of our global asset mix. The result of that rebalancing was about 1/3 in each of Canada, US, and global markets. However, what we've seen as kind of major contributions to the performance, particularly if we're looking at this last quarter, was exposure to the Asian markets, which that represents approximately 1/4 of the portfolio. We focused that portion of the portfolio on Japanese and Korean markets, where we've seen a number of our holdings perform very well during the recovery. The partner we work with in this region focuses on undervalued stocks right across the capitalization spectrum, but our holdings over this time have primarily been in the mid-cap to smaller during the period. On the North American front, our exposure to large cap and mega cap stocks have continued to contribute positively to performance. And finally, from a sector perspective, we have about a 27% exposure to information technology, and that's been a positive contributor.
So Glenn, how about the mortgage pool? Is it continuing to do well? Recently, there have been articles coming out about residential rents dropping as well as condo vacancies rising. Could you give some comments there in terms of whether we've seen this playing out in the funds and what sort of contingencies do we have to protect ourselves from a slowdown in the real estate market should it come?
Yeah, I agree. The mortgage pools continue to provide a consistent source of income flow. It's had low month-to-month volatility throughout the year. Overall, real estate market has remained resilient during the last number of months as the economy's reopened. But there have been a number of articles indicating residential rents dropping. But residential rents dropping and condo vacancies rising, to some degree are connected. And these articles are typically referencing major centers like Toronto versus maybe the broader GTA, Greater Toronto Area, or Southern Ontario. At current portfolio, we have very little exposure to what we'd call purpose-built rental at this time. But anything we currently being considered for the portfolio is really being assessed for its viability based on the current market realities and the current interest rate and government programs that do exist right now continue to make that actually reasonably attractive to investors. Toronto currently, it's like a lot of the big cities around the world. It's seeing some movement of people out of the downtown core and into the suburbs due to the pandemic and concerns around being in densely populated centers, or just the realities of more people being able to work remotely. This movement actually has been positive for our strategies. We primarily focus outside of the main Toronto core. That's due to competition as one thing, but it's also due to suburbs, kind of the mix of housing types and property types there being more resilient in down markets because the demand tends to come from multiple sources like single parents, young families, downsizers, retirees, and so forth. So there's a built-in natural protection as the markets, if we run into some negative pullback in the markets. But then on top of that, we run the normal factors of diversification, where we're looking for varied developers, sectors, project types, and locations to mitigate a lot of the uncertainty in the marketplace.
So before we wrap things up, one final question, because I always feel it's nice to look ahead and get excited for what's coming up in the future. So Glenn, can you tell us what are some things that you and the investment management team have been cooking up in terms of new investments, maybe even pooled funds?
Sure. We like to view our funds through the lenses of core and satellite funds, where core would represent a non-traditional equity, traditional equity, and fixed income pools. With the launch of the Capstone private high income pool last year, we made our next kind of expansion to the satellite fund lineup, which until that point really had been made up primarily of mortgage strategies. This strategy has actually held up well. It's performed well, particularly having been launched just before a global pandemic. We're excited about some of the opportunities that we're assessing for this strategy. We're trying to take advantage of some of the disruptions we have seen coming out of the pandemic situation. And those, we're looking at areas like aviation industry. As the disruptions work their way through, there are opportunities presenting themselves that we see coming in the future there, as well as looking into private lending opportunities within the corporate mid-market space. Additionally, we are looking to expand that satellite fund lineup or the options available. So we are focused on several strategies there that we do believe will allow investors to better customize their risk-return profile. These include areas such as infrastructure. We're also looking at real estate, media, and private equity, and hope to have some kind of news or announcements on some of these, at least in the near future.
Glenn, I want to thank you for joining us and taking the time to share your comments with us. So thank you and bye for now.
Bye. Take care.
Bye-bye. So Janet, what are we looking at for our next video update?
So we will continue on our theme of financial planning strategies, going over the most effective use of different types of accounts, including the TFSA, RIF, RRSP, and of course, taking into consideration any suggestions from our clients that we get along the way.
Thanks, Janet. If you would like to find out about any of the opportunities that we spoke about today, please be in touch with us by phone or email. And until next time, bye for now.
Bye.